Happy Wednesday, everybody. It's another episode of Ask Me Anything Happy Hour. And the hour, well, we're going to make it happy without the liquor. But if you want to get some alcohol or a drink or a fine wine or whatever it is, be our guest. Grab it, enjoy it, but just have your questions ready because that's what this whole team's here for, is to answer whatever questions you have and do it with having some fun. We'll be right back after this. All right, back at it. Ask Me Anything Happy Hour, where the team gets together and we answer your questions. So we're going to start with our famous Shauna, or should we call her Donna today? And she can give an intro.
All right. I asked ChatGPT for help, Shane, but it was like, think of me as the person who already has the solution you haven't thought of yet. And before you ask me what I do, let me tell you I do it better than anyone else. So that is me. And I'll pass it over to Brian.
Hey everybody, Brian Futzer, one of the mentors up here in northern Idaho, just getting prepared for winter, which is kind of a lot of work up here. So that's what I spend my free time doing. Yeah, down the Lennis.
Hey everybody, Lennis Nolt here from Hopkinsville, Kentucky. Today I'm joined off screen, well let me show you, by my 5-year-old daughter, Eliana. So she is listening in and learning from the best. I'm dealing with this unruly beard. New to having a beard. People tell me, well, you grew up Amish. Surely you know about these things. No, I grew up horse and buggy Mennonite, so very similar to Amish. But one of the big differences is that they do not have beards. So I'm actually the outcast having one. But all that to say, I don't know much about beard maintenance. It wants to curl one way, it wants to curl the other way. If anybody has a good solution to holding it in place without using products, I'm all ears. Anyways, Tess, over to you.
Yeah, I'm Tess, and I often say I've been around insurance my entire life. It's something that I love. I'll share something I did playing in the vault the other day. I asked the vault what the 21 most common questions are in AMA. So I have a book. And now I will share it with Jason.
Thank you, Tess. Hello. Another wonderful Wednesday. Or remember that hump day. Woo, woo. If anybody misses the camels, let's bring them back. They were fun. Almost as good as Twist to Open, if you guys remember that. The What's Up? So I'm going to go over to my buddy, Mr. Joe Helock. Get your questions in. I don't see any, but we are ready. Let's get some questions.
No questions. We need questions. We need something to do for an hour, or we're just going to keep on battling back and forth and talking, and you're not going to want to listen to us. Keep on going and going.
I can help. Chad Chris said the number 4 question asked in AMAs is, how is this different from a regular whole life insurance policy? Okay, go for it, guys.
Okay. I think we still got Carson. I didn't hear anything from Carson.
We still got to go to Carson next.
Yeah, he's up there, Joe. He's over there. There you go, buddy.
What's up, everybody? Last one here today. Excited for AMA. Thank you guys for being here. If you guys did not get to attend our virtual event this last weekend, you need to get the recordings. Man, was it good. Everyone on this group here spoke about what they are passionate about, what they're educated on, and they taught straight wisdom, guys. So if you guys are not familiar with the virtual event we did this last weekend, please ask. We will give you information we'll give you the links to get the recordings as well. But that's where I spent the last few days. Last weekend, we did that with everybody. It was awesome. Hope I see a few guys on here who were there as well. So if you guys are in the chat, let us know what you thought of the weekend. Let us know what you thought about the virtual. And if you have any leftover questions from the virtual event, guys, let's start there too. So excited for AMA. Thank you guys for always being here. If you guys don't give us questions, we'll go off of what AI says we should talk about. So if you want AI to lead the meeting, that works too.
Love it. We got 2 questions. So Capital Flow Solution is saying,
hey guys, I'm Stephen Nagy. Take over me sometimes, and no, just kidding. Go ahead, Shauna.
I don't even know what this means. FOMC. What are the SWOT of this drop?
Yeah, it's basically just the meeting that the Fed just had today, essentially. I don't know what the SWOT. Do you mean like a SWOT analysis of it? I'm not too sure what that means, but basically, the Fed dropping rates 25 basis points, and saying that there could be 2 to 3 more cuts. I think I got that right. It was, I believe, 2. I don't remember how many more cuts they said. 2 more cuts this year is essentially saying that the economy is slowing down. It doesn't say anything else. That's what they're saying. They're trying to kind of say other things to kind of just alleviate that. But essentially, I mean, the market acting exactly how they should to that. I mean, I'm surprised the Dow is still hanging in there, but NASDAQ, S&P, did the Russell go negative? I'm not sure if the Russell went negative, but essentially there's your indicator. That's what the markets think of it. It's been anticipated. It's been a lot of emphasis on rate cuts, and it's been kind of driving the market up. But now that it's happening, which is kind of weird how the market builds in increases for the cut, but then when the cut happens, they're like, oh my gosh. But it basically is just showing you the economic position that we're in right now. And I think you're going to start to see unemployment number. Typically what you have happen after rate cuts is you see unemployment numbers start going up. You'll see, more layoffs. You'll see, just a lot of economic indicators showing what we've been talking about forever. Hopefully that is what you were asking about. I'm not so sure if I nailed it, but if I didn't, just let me know and I'll take another shot at it.
You might be the only one who knows if you nailed it or not, too, at least right here. So maybe Steven knows.
Well, I mean, a SWOT analysis would be different than what I just said, but I don't know if that was a typo.
Yeah. Well, SWOT, strength, weakness, opportunity, threat. I think what that is.
Strength, weakness, opportunity, threat. Correct. Okay. It's MBA stuff right there.
All right. Lynette is saying, what happens if we are denied coverage by one of the insurance companies? In what way can we practice infinite banking?
Oh, I like that one.
Mm-hmm.
So, I mean, by the way, a denial by one company does not mean a denial with every company. So keep that in mind, because every company has different underwriting guidelines. So oftentimes we have, like secondary companies, we can sometimes go and ask if they consider coverage. So just kind of keep that in mind. It's not like and also it depends on why you're denied, and there might be a time horizon as to when you would be insurable again if you were denied for some reason. So that's that part of that question.
And then the other way to practice infinite banking would be other insurable interests, which Brian was getting to talk about, your spouse or maybe children, adult children, business partners, just who is another insurable interest in your life that is on board with it. That is super imperative, because lots of times people who have been denied will come in and they want to use partners, children, other things. And if they're not on board, that makes the process a lot harder. So just make sure you're training or sharing the same trainings that we're providing all the time with those folks as well, so they can get their heads wrapped around what this process looks like.
Just speaking to sorry, go ahead.
Speaking to the last part of the question, how can I practice infinite banking? It's an important question, because infinite banking is the process, not the product of whole life. And so that process of paying yourself first, and then for that money to go to work for you, and not to basically be set aside, to not just be consumed on whatever temporary stuff. So it's a good thing to think about.
Yeah, because I've seen people use it with a 401k loan. You can, there's other ways you can practice the concept. I mean, it's not the most efficient way, but there's other ways to sort of practice it. It's just obviously it doesn't have all the benefits of a whole life, especially design policy.
All right. PV719X is saying, hello. In the future, I will have no debt and a good amount of cash flow. I do velocity banking with my credit cards for expenses. Jason is who I am working with. I may have to chat with him more in depth. We definitely encourage that.
It's awesome.
Kathleen.
Well, congratulations with taking action, right? You're freeing up cash flow. That is step one, is have cash flow. And then we teach you to change one thing, and then you'll come back, we'll talk. And we can even show you in the vault now what that looks like, how much that accelerates, and everything else based on what you're trying to do.
I love it. And Kathleen is saying, how can I get the recording? Sorry, I had to miss it. Can't wait to watch. So from the 2-day, how can we get the recordings?
That's all, Steven. You got the link, Steven? Want to put it up there? Yeah, Kathleen, we did make that available on Wealth Webinar today, so we'll share that link down here.
Yeah,
And
it's
just gotta cut and
you know,
paste
it's beyourownbank.com/blueprint.
Beyourownbank.com/blueprint.
Sometimes it's hard to share a lot in the comments on here. So
All right, well, you put that in the chat. Eric has kind of 2 questions. So he's saying, my agent says maxing my policy for 8 years is better than only having the max for 3 years. I want to just do the minimum after 3 years, but he says not to do that and just fund it lower after 3 years.
That's a great question, because that has to do with policy design.
Yeah.
So the question on that one right there is one, is your agent part of our group or somewhere else?
No, and
they're not part of our group with a question like that.
Yeah, because what you could,
No
you
way.
could do a premium with a 3-year dump in, and that would accomplish what you're probably trying to do. And so you could do that. There's more than one way to do this, but you got to get a little creative.
More to his question too is saying, my agent also said to have the term rider stay on the policy for the life of the policy. And then after 7 years, I can call to remove it. Why not remove it after 7 years now before I sign?
Well, that could be more of a systems thing. I don't know what insurance carrier that is, but sometimes you do have to call and cancel the term rider. We try to use a term rider that is a 7-year term rider or a 10-year term rider so that it automatically just drops off. But there are companies like I'll pick on Mass where, yes, you have to drop the term rider at that specific time to make that happen. So it just depends on the carrier. So I don't want to fault the agent for that, but I'd have to believe that carrier has riders that are for shorter periods of time.
You can't even have a term on there for the life of the policy. That's impossible.
No, yeah, Brian, like, don't be nice. I'm trying to be too nice here. I was mean in WTF. I'm trying to soften a bit as the day gets younger. You have at it.
That's not even possible.
And Eric, another part of this too, what I thought immediately when I saw your question was, if you're trying to stop after 3 years and we want to know what you're trying to accomplish so we can help you tie your goals, right? What are you trying to accomplish right now to the longer goal? But if they're saying, hey, it's more efficient if you keep capitalizing the system for 8 years, of course it's going to be more efficient because you've put more capital in, there's more growth, there's more happening and compounding and going. So that might be true. And also it's kind of curious that he picked that number as well for commission reasons, perhaps. So there's a lot of moving pieces, but we'd want to know, what are you trying to accomplish? Maybe even look at what you have approved, and we can say, hey, yeah, this is a great policy, you should go ahead with this. Or, hey, what are you really trying to accomplish? Maybe we can actually help you get your goal.
And also he's with Penn Mutual, so
isn't that a direct company?
Yeah. So I mean, obviously, Eric, hopefully you understand direct versus non-direct recognition. If you don't, just go look it up. Go to Chris's YouTube channel and search in direct versus non-direct. You've got to be very aware of what a direct versus non-direct is if you're trying to do infinite banking. And Penn, we don't usually write with Penn for that reason, although we can.
We are contracted with Penn. I don't want Penn policies written. I just don't. A lot of reasons we don't need to get in. I'm not saying they're a bad company. They're actually a great company. But there's just a lot of reasons why, here's the thing. A lot of agents use Penn, and I'll tell you why. They illustrate really well because they basically have a weird way of illustrating using showing future dividends. They don't show current assumption, meaning they don't assume that today and every day there on out, the dividend will be what today's dividend is, which is kind of a standard in the industry, because like if you get your illustration done today, they're going to run the illustration based on today's dividend moving forward, which is actually a really unique way to do it, because we've been in a relatively low, actually we've been in a historically low dividend environment for the past 20 years. We're just now starting to kind of climb up a little higher, but we're still not nowhere near where they used to be. What Penn does is they don't use current assumption in the future. They have some system or calculation that they do that kind of makes it kind of, I don't know how they do it. I truly don't even want to begin to understand it, but it makes the illustration look really freaking good. But my fear would be is those illustrations, although they look good on paper today, they may not materialize to be what they are. I take a lot of pride that for the 10 years we've been doing this, the illustrations I did, 10 years, 9 years, 8 years, 7 years, 6 years, 5 years ago, every one of them, the people have more money than what we illustrated. Okay. But if you use pen, that probably isn't going to be the case.
Yep.
Take that for what it's worth. I'm not saying pen's a bad company, but do understand that and understand direct recognition.
Must be some kind of like cost of living increase or something like that, right? Like
Patrick tried explaining it to me one day, and I'm like, oh, enough. I'm just not right with them.
And a 3-year dump in, that's fabulous. But now why is he only going to keep on funding it for 8? Why does that mean that you're not going to spend any money after 8 years? I want to run my money.
I wonder if the agent's bank. I wonder if it's banking truths, because that's been an interesting one.
And Joe, it's a great question. I talked to a woman earlier today who, at this point where she's at in the journey, that was her thing. She's like, look, I'm 63. After 8 years, I don't want to be putting anything into my policy. I'm like, even if you hand me $1 and I hand you 2 back, you don't want to give me $1? And she's like, no. And I'm like, okay, well, I'll still design it in case you change your mind in those first 7 years. And then you can say, okay, let's go ahead and change it and do an RPU at year 8 if we need to.
I've used a bunch of limited pay, like 10 pays in situations like that, because, listen, at the end of the day, the client's always right. I know they're probably going to regret it, but listen, that's what they wanted. So I've done that. And now we know that after that period, it's done, but you could accomplish the same thing with an RPU. So I guess really your way is probably the better way to do it, because they have options where if somebody does a limited pay, they have no options. It's just at that point in time, you can't put any more money in, even if you want to.
Yeah, it's just important to assess in a deal like that, is because some companies you will lose all your riders if you RPU, and so you want to be aware of whether that's the case or not, because you don't necessarily want to lose your chronic and terminal illness riders when you RPU.
Yeah, I've never had anybody do an RPU. I have not as of date, because everybody that runs the math when they can RPU is like, why would I stop putting money in this?
The policies that I build in years 10, aren't they 200 to 300% cash on cash? Why would you want to stop contributing? That's when you want to put in more.
Yeah.
It's really just more of a mental thing, that they think that they want to be done, because that just in their mind that's like the day they don't, they're still in that mode. When someone says that, they're still in that mode of thinking of this as an expense, not
scarcity versus abundant.
That's all it is. That's all it is.
Robert, RPU is a reduced paid up. It's just a way that you can stop. You level out the premium, you level out the death benefit, and you stop putting in premiums after a certain year. It's usually after year 7 or year 10, depending on the company.
So we've been helping Eric for a good minute here. I would say, book a call with us. Somebody can drop the link down there. We're happy to help, and just from a straightforward perspective, give you our perspective on the policy that you're being presented with, and we'll be happy to tell you if it does fit your needs.
Yep.
And two, if he plans on borrowing the money and utilizing it for investing or paying off bills, he won't be getting the dividends either.
Yeah, there'll just be a little bit of a disconnect. We definitely appreciate you coming to our channel to learn from us about infinite banking. This policy, the way it sounds like it is, with it being direct recognition, it's not going to totally match up with a lot of the stuff that we're saying, because we're speaking from a different style.
Mm-hmm.
So something to consider too. Okay, Dexter's saying, so let's see. Will it be a repeat? People will use their equity as an ATM again with the low rates. They lose their jobs or AI takes it, then defaults become worse than they are now.
They're not. The rates aren't low. I mean, it's a 1/4 point drop. It's barely noticeable. If they drop 3 times this year, we're still not low. What you're referring to is you're referring to like the time when we'll probably never go back to that again. Those, unbelievably low rates that were a smidgen in time that shouldn't have been that low. It was a knee-jerk reaction. But I think right now the one thing that you say that's really important is defaults will become worse than they are now. It's hard to fathom defaults becoming worse than they are now. I mean, we were looking at reports on WTF today. It was showing the inquiries for mortgage help exceeded 2008. Now, you got to take that with a grain of salt, because some of that could just be because more people are online, and more people are searching. But it's still alarming, and there's no question delinquencies are way up and climbing fast, which means defaults will come next. And will people be using equity as an ATM? Probably not, because, well, I don't. Here's the funny thing. Here's the question I would pose: is how resilient will the home prices be as things slow? That's going to be an interesting thing. You could see housing stay elevated, from an appreciation standpoint, or as some economists are saying, you could see real estate fall off a cliff, because there is literally just less demand than there is supply right now, which is a flip. There used to be way more demand and less supply. Now that's flipped. There is a lot of houses on the market and climbing at a rapid rate and sitting on the market a lot longer. So you all know where that goes. At least if you study history not too far back, you'll know where that goes. That means price has to come down. That's the only way they move. So it'll be interesting, Dex. It'll be really interesting to see what happens. I couldn't put a gauge on that one.
All right. Rob J is saying, I made a PUA payment yesterday to my SML policy. Today, I got a confirmation email that they received my TPC rider payment. Anyone know what TPC rider is? Did I make the right payment?
Yes. I'm actually looking at your policy right now. That's the right thing. I had set it up for that.
There you go.
That's crazy. Shows how good our technology is, folks.
Great. Okay. Navigate Your Ventures is saying, the more and more I dig into the vault, it seems like a jawbreaker I would buy for a quarter as a kid, layer upon layer of value. Every color change is a whole new function.
That's awesome.
Yeah. And then Zanelli is saying, sometimes I'm afraid of this, but I'm going to trust the process.
That's it. You either think you can or you think you can't, Zanelli. And either way, you're going to be right. So how much faith do you have? How much education have you given yourself? And whatever your thing is, like some people have to punch holes in it with the numbers. That's what the vault's for. Some people just want to understand the process and the thinking, the logic, the reason, the prophecy behind it. Wherever you lie, maybe somewhere in between, you just have to know that you can do this. And then it's a whole process. Like once you start, once you get approved, once you fund your policy, guess what? You didn't really do anything yet. You just got approved and started your journey. Now you're actually doing the thing. Because a lot of people get the policy. I have 2 personal friends who took their policies with specific reasons and haven't done a damn thing yet. Guess what? That's not helping them at all, other than their families are protected. And now I followed up with both of them to say, hey, take the loans, pay off your company vehicles, do your remodel. The guy was about to go to a bank and take a remodel deal until I showed him the math. I'm like, why would you do that? So Zanelli, back to my first point, you either think you can or you think you can't. Either way, you're going to be right. So keep the faith.
And kudos to you for actually jumping in to learn it, because a lot of people walk away instead of challenging what they know. And that's what we always talk about. It's what you think you know that just ain't so that's going to cause you a problem. So kudos to you for doing it.
There is no risk to a whole life insurance policy. Guaranteed.
Yeah,
right,
there you
Chris?
go.
How's the word? Guaranteed.
Guaranteed. And just so you know, I thought it was too good to be true in the beginning too, and look where I am now on this side of it.
Anyone else think it was too good to be true when they first read about it? Does anybody here? Maybe? Show of hands.
Nope.
Joe, come on, man. You were pulling him back and forth across the
Yeah. You were the you were the 3-car guy.
Yeah. Lost a lot of time and money, but we're okay now. We fixed it all.
So we've all been there with you, and we're cheering for you because you're still in the game.
Yeah, just whatever you don't know, you just don't know it yet.
Yeah.
She did add that her policy is now
All that.
approved.
Yes.
Yay.
And then also asks, when will you have another in-person meetup? I want to interact with more people like us so that this will rub off on me more.
November.
Orlando, the city beautiful, as Steven likes to come visit.
October Mastermind.
If you're in Buffalo every month, first Thursday of the month.
Yeah, I got the link up there
So
for
nobody.
the mastermind in October. Shauna, if you're able to grab it from the other chat.
Yeah, and then Steven, do you want to put in Orlando too?
Yeah, but there's no way I can put all this in chat on StreamYard.
Okay.
Yeah.
Let me
Do your
try.
best. I'll keep going with the questions.
Okay.
Okay, so Shane from Navigate Your Ventures is saying example of velocity banking only using my HELOC or policy.
We should use GoToMeeting, Chris.
No.
I used that thing for 6 years. It's horrible.
Yeah, it's tough to use.
Okay, so
Are they referring to the vault when they mentioned this?
it might be. So do you select them individually for your debt tool? Of
Yeah, you
choice?
can choose. That's what's cool about the vault is you can use a HELOC, a policy. You can choose.
And you can use them together. It's the only software that allows you to integrate. We call it the trifecta. Integrate IBC, velocity banking, and do them all, and the like that avalanche or
the math. Whatever. Yeah, the math. I never know what to call that piece either, Chris.
Yeah, the map or whatever. The mathematical pay down. The fastest way to do that in conjunction with velocity and IBC. So the software will allow you to integrate all three or each individual one.
And then PB719X is saying, where can I view the vault?
Steven's got a link for that too.
Yeah, BYOBvault.com. BYOBvault.com.
And is that just do you have to immediately subscribe to it, or is there any sort of like viewing process?
There's a 7-day free trial.
Nice. Okay, cool. I did not know that.
Me neither.
Okay, so
Steven, did you type that wrong in there? VAT?
Yeah, I think
Money
so.
Club? That's not gonna
it says Chris Noggle typed it wrong, so it must have been you, Chris.
I told you it doesn't copy right. I think it shows up right on YouTube. I just think on here it looks funky for us.
Yeah, it should say privatemoneyclub.com.
Well, it is the first part if you look up above.
Yeah, it's weird. Okay.
Okay, so when I get married and for my son, so we cannot get sued if a divorce, can the ex claim any of the funds in the policy?
Yeah, good luck with that. Yes.
Well, we're not legal professionals, but
yeah, we can't give legal advice, but I can tell you right now, getting sued and judgments and liens are very different than divorces. Check with your attorney, check with the state you live in. I know my state, you're pretty well screwed in divorce.
Yeah, state specific.
Stay married. Stay married.
Yeah, state specific, and probably a function of how well you planned at the beginning of the marriage with agreements and things and such, right? So
yeah. I think that would have a lot to do with it.
All right, David and Dorothy are saying, is RPU the same as face decrease?
No.
Probably. They're probably different, but the idea essentially is the same. We did not mention this earlier when we were talking about RPUs, but if you do RPU the policy and the policy was set to have the premiums paid forever when you first built the policy, then when you RPU it, they actually will lower your death benefit. The face amount will decrease. So, I mean, yes. I don't know if you're referring to something else, though.
No, the simple answer is no, they're different. An RPU is a permanent thing that cuts premiums off into the future, where the reduction of face is just a lever you can pull to kind of adjust premium deposits. But effectively, like Carson said, an RPU does drop the death benefit because they're going to look at you paid in for let's call it 10 years. 10 years is enough to prepay X amount of death benefit, but you've got Y index death benefit, so it's going to drop from Y to X, to be supported by what you paid in premiums. Reduction in face is just different. It's a future reduction because you reduced death benefit into the future.
Okay. And then Terry Crutchfield is saying, who on the team can help me look at one of my policies to RPU?
Where's that call link?
All right. And then Knights of Israel saying, I have a Lafayette whole life insurance policy. When will I be able to start loaning 80 to 90% of the premium payments? Right now it's about 40% currently.
That's super weird. You may not have set that policy up with us, or maybe you're not understanding how the portal is showing you the cash value, but you should have a lot more cash value available. Your cash value should be a pretty high percentage of the total premiums you've paid, especially if it sounds like you've already had the policy for a little bit. If you're years into
I feel like he's one of our clients. I do.
I do too. Which is why I'm confused.
My thought is that maybe he just put in the monthly or annual premium and has not put in the dump in yet. Then it might look like that. Other than that, I don't really have an answer.
It actually sounds like they didn't put the PUA deposit in. They just did the base premium, not the PUA. That could be it too.
That would also be weird, though. Then why would they have access to 40% if they just paid the base? Right? It would be nothing.
Good point. Good point. Yeah, something's wacky there.
Schedule a call.
But let us know.
Based on this person's questions in the AMA and other places before, I don't think he's a client with us, but I may be wrong.
I'll ask him right there.
Yeah.
You a client of ours or not?
Let us know. Knight of Israel, you've been around for a while. I've seen that logo and
give us more.
Oh yeah, I've been around for a long time.
Jordy, what's up?
Yep, and then after Jordy, we don't have any other questions, so keep them coming. Jordy is saying, if I continue adding additional PUAs every year during the early years, will that hinder me from adding PUAs in the later years?
Jordy, at some point, my understanding is that you won't be able to fit any more additional PUAs in, but that's kind of the point of getting your banking system as efficient as possible and getting the growth as fast as possible, getting the money in motion, like we've been talking about what you've been setting up for yourself and your kids. Does everyone else kind of understand that the same way? At some point, you won't add anything additional in?
Depends on the company. This is a company specific kind of a thing too, and how the policy was built. Because with some companies, you can add them for 50 years, 121 years old. I mean, you can add them for a long time. With some, they're going to limit you. There's quite a few factors that do this. I did one recently where someone's doing dump-ins for 7 years, and after that, boom, the PUAs drop. So they have to drop them off because of how much they're putting in the early years. Then someone else is doing a monthly premium, and they can put in PUAs for their entire life. So a lot of factors that can affect that.
Yeah, I've worked on all of Jordy's policies so far. They're all with One America. If I remember the designs correctly, you'll be able to add at least some additional PUAs for the life of the policies. But as much extra as you've been putting in the early years, maybe you'll get limited sooner according to MET calculations. So it could be a good question to ask the company directly. They'll be able to run some calculations to tell you what it looks like at this point.
And Linus, like to that point, like yes, they're designed. I believe the newest ones are all designed out to 121, right? With having the PUAs attached. That's how we did them. And at the same time, you might ask somebody in policy services question, and they might give you an answer, and it might not be 100% accurate because as you go in and as you're asking the same question, they run the calculations. Those are moving. So I don't know how clear of an answer we actually get. I know it's not a great answer, but that's kind of been my experience so far with this. Just keep asking the question. And someday if they tell you no, tell us.
All right. And then Jake is asking, what is the interest rate paid to the policy owner based off of?
And I'm assuming that Jake, you're referring to dividend rate. That's a great question. I have a very simple one I give. I'm not sure what everybody else is. I'll let someone else go, but I have a very simple answer to this one. The insurance company's overall portfolio performance.
That's all it is. It's think of it like it's, Dave Ramsey's answer would be, it's just a return of unused premium. And to Dave, I would be like, yeah, you dumb idiot. Isn't that the same as profits, asshole? Excuse my language. But it kind of is. It's like, hey, these are the premiums that we took in that we didn't use. In other words, Dave, you mean those are technically the profits of the company, because having a hard time understanding the difference. But Dave's a smart guy in the room, so let's listen to Dave. He makes it sound like a bad thing. You know what I see in that? I'm like, you know what? That's freaking brilliant. Because according to the tax code, if it's a return of unused premiums, it's tax-free. But if it's a dividend or profit, it's taxable. Which do you want? But
And
that's what it is.
honestly,
It's general performance of the portfolio in the insurance company.
Well, Dave just knows about terms, so he just keeps on taking it in and doesn't pay anybody.
I'm just taking low shots. That's all.
I wanted to join.
And Dave
will never debate me. He'll never debate anybody because he's never wrong. He's got an ego the size of Texas, and that actually probably bigger, but dude's never wrong.
it does speak to the conservative nature of an insurance company too. I know from my days in the offices, you want them to reserve at a higher point so that you're always covering losses. And every year in the fourth quarter, we always go through reductions or returns. Why? So that they can return the funds back to the policyholders after the year-end processing's done. Because they know it takes 7 years for the tail of a policy to run, generally if it's liability, and they just bring back into premium anything they feel they're not going to need as that year develops. So it's actually conservative, but why wouldn't we support that?
And I was wondering if he's just talking about the interest rate. Just depends on the company, right? If you're just talking about the flat contractual guaranteed interest rate, it just depends on which company.
Yeah.
That used to be, and it's funny because like pre-7702, that was a industry standard. It used to be 4% across the board. Didn't matter what insurance company it was a standard. 7702 came out and sort of gave the freedom, which was a good thing, the freedom to the insurance companies to decide. And prior to that, we were like, oh my God, this is the end. It's going to all suck. Nothing's going to work. And then they did it. And we're like, oh, now we can design these things at even higher MEC limits. Oh my gosh, we can stuff more money into these things. Wow, we can make these things even more efficient. So even though the interest rate was higher, the guaranteed interest rate, the dividend never changed. So if Mass was at 6 and their 4 was the guarantee, like 2% was the dividend, then Mass dropped, let's just hypothetically say, to 3 from 4, the dividend was still 6. So all it does is essentially takes risk and pressure off of the insurance companies to have that guarantee, but the insurance companies will probably never, ever miss the guarantee. It just alleviates pressure on their portfolio to have to perform at that guaranteed level, which in those low interest rate market cycle that we just came out of, it was next to impossible for an insurance company, over a 30-year span to invest money conservatively enough where they could support a 4% guarantee. So now you got insurance companies that went to 2%. You got insurance companies that are at 3. You got insurance companies that are at 3.25. And all of those vary in how we design the policy. But at the end of the day, like if you just focus on the dividend crediting rate, that's probably the best way to look at it, because the insurance companies have never, ever, ever, ever missed the dividend. So why would we just focus on the guarantee rate when they've never missed the dividend? So you're the probability would be better to be looking at the dividend crediting rate than the guaranteed rate in terms of what you're going to get in the long run. But dividends are not guaranteed, because the compliance officer is staring me down right now. Dividends are not guaranteed.
Ever, not guaranteed, ever.
The guaranteed rate of these policies, though, is actually going up. A couple of these carriers are coming out with newer products that have a higher guarantee, which is great. But most of what we're writing is still in the range that Chris said.
They're all just trying to be more competitive, and now they got more levers to move to be competitive. It's a really interesting time to be in the life insurance business. It really is. It's a fascinating time because it's evolving and changing, but still staying core to its roots. So I don't think there's been a more exciting time to be in the life insurance business than now.
Sorry, I was laughing my ass off because Dexter wrote, "We are losing Sir Joe. He is blinking and staring too much."
I was laughing too, and I was thinking it's not really Joe. It's actually AI Joe, and Joe's not even there. He just walked away from it. And that's it.
I do have 3 minutes left because I have to go to a field hockey game. But
Well, now we're in field hockey season. Very cool.
All right. Navigate Your Ventures is saying, what are the 4 buckets Brian and Jason were referring to when you are starting your IBC journey?
And are you asking about the
avatars? The avatars.
Yeah, the avatars. So there was the legacy-minded provider. That was the first one we talked about. And then we talked about the late starter legacy builder, then the strategic investor, and then finally the debt liberator. And so if you're the debt liberator, your driver is freedom and ownership. And that was someone who's done with banks. I'm done paying the credit cards and everybody else 25% of my money on an annual basis and not having a plan. They'll never pay it off. Strategic investor is the person looking for growth opportunity. You're building the opportunity fund out because you want to go leverage your money, make the spread Chris is always talking about, keep your money going in that circle and make more money. The late starter is someone who, basically every single call we talk to, whether you're 30 or 50 or 60 or 65, 70 years old, it's always, man, I really wish I would have known about this earlier. You might feel like you're a little behind. You might feel like you're uninsurable, but you're really driven by redemption and hope, knowing that there is a way for you still to take back control and to have a different path forward. And then finally, with that legacy-minded provider, I'd say it's kind of one I identify the most. And you can be all these things and you can go from one to the next. But that's, for me, this is a one where all of a sudden you're saying, hey, I'm generation one. I'm setting up my family with the systems and processes and thinking and logic and protection for generations to come. So I can be like Grandpa Chris, having, my great grandkids receive cards on their birthdays and be like, Grandpa Jason? What the heck's this? How did you remember? You've been gone for 100 years, right? It's your driver's responsibility and provision for those folks.
I love it. He says that was a huge eye opener for me, created a lot of more clarity for my goals. All right, Dexter's saying the term rider is the rocket to get the policy off the ground. Then it's released once you get into orbit and the policy starts to coast on its own, right? At that point, it's not needed because it fuels itself.
Yeah, the term. Well, yeah. I mean, ideally, the better way to say that would be the PUA. The paid up additions are the rockets, but you can't have the PUAs without the term rider in some cases because of the mech limits. So the PUA is the rocket. The term is kind of the
loop.
It's the tax shell. It's the armor to keep it.
The term is the heat shielding around the rockets.
Yeah.
There you go. I like that. I've never thought of it that way.
Me neither. I had to think on my feet there.
That you did a great job. That works. And Dex, the rocket is basically, once, and just think when you add the PUA dump in the rider, that's just to accelerate it to get it up faster, right? With that heat shield to make sure that as you go faster, it's not blowing up. And then the actual ship, the shuttle, is what is actually driving that long-term growth, and it drives a lot of the dividends and a lot of the protection and the legacy multiplication and things as well. So if you can have your cake and eat it too, that's why we have some of the different designs that have shocked Chris in the past. Joe has shocked Chris, literally said, you can't do that. And then wait, it's a 50-50. In year two, it's a money tree. Get the hell out of here. So that's how you can have your cake and eat it too.
You're still challenged.
Do later, guys.
Hi, Joe.
Hi, Joe. All right, Robert's thing is, I was under the impression that dump-ins and PUAs must be established and fixed at the start of a policy and can't be updated.
Yes, and no.
Kind of. I would say
a little wiggle room, not a lot.
I would say down, not up.
Lennis, how would you answer that? You're the technician, so what would you say to that? Because
here's the thing: you can design a policy.
That one.
Yeah, you can design a policy to accept dump-ins in multiple years, not just the first year. So it has to be set up for that. And some of the things we talk about as far as putting in additional PUAs throughout the life of a policy, that might be the smaller flexibility Chris is talking about. But dump-ins, they can be designed for more than just the initial. So that it's always important for us to drill down on exactly what you're trying to do, how it's going to solve your needs, and then we design that kind of thing from there.
Yeah, I just always don't like these questions because I got called out back a while ago. They're like, well, Chris Noggle said that they build it right to the mech and you can't put any more money than what was set up. But I called the insurance company and they said I could put another $150 in. I'm just fine. I'm just never saying that again.
Just
Yeah,
as
well,
Steven
Chris,
said,
remember that all humans are deletion, dilution, and distortion creatures. So they just hear what they want to hear.
Right.
It don't matter how many times you tell
Right.
them.
Like
they
I'm
just-
sure on every video I say that you can just borrow the death benefit and it has nothing to do with your cash value. Like, yeah, I've heard that one a lot too. Oh, Chris Noggle said I can borrow all the death benefit out. Right. Please show me the video where I've said that. I'm sure that one was never ever in.
we'll ask Chris
They'll
AI.
take a little snippet. They'll take a little snippet. There you go, but not the
Oh,
whole.
there it is.
Yeah,
Oh, that was 1 second. Great.
That was 5 seconds, yeah.
What's before and after that? And it's collateralized by the cash value. So whatever the cash value is, the amount you can borrow from the general account, which is essentially taking your death benefit because they subtracted from that. Oh yeah. Oh, I heard death benefit.
Yeah, it's so nuanced. Every company is different, and then within every company, every design is going to be different. And I would say efficiency and maxing out the MEC limit aren't necessarily the same as far as when it comes to us setting up the initial design. Sometimes I see the most efficient design leaving some room for extra PUAs that, we've done the very best we can, and that just happened to be a byproduct of that specific design. And then other times, the most efficient design is going to leave zero room for extra PUAs, and it's always different.
It's funny. I just had this weird thought in my mind, Jason. Like sometimes you tell me what people tell you, and you're like, Chris never said that, and they're like, no, I swear I heard it on one of the videos, and then it makes me think like that person is probably taking a poop, petting his cat, on his phone texting while watching YouTube on some other screen in the house, listening from afar. That's just the visual that came into my head. I don't know why they're taking the poop part came in, but yeah, whatever.
Just to make it fun, man. Just to make it fun. And that's the truth. I had that call today where someone's like, yeah, and like with the way she was talking to me and the certainty, I'm like, wow, she said 3 and I was ready for years. And she said weeks. And then she said, my brain is the kind of brain that when I'm working on my work and I'm doing all the math and spreadsheets and stuff, I've got YouTube in the background. I'm doing this over here. And so you can't have everything coming in and get everything right at the same time because you're listening and focused on many different things. You're just picking up pieces here, pieces there. And there is no such thing. My whole point, there's no such thing as multitasking. What
I heard there is she was dealing with 4 children screaming while texting a work colleague while writing a note for the teacher's parents and listening to Chris.
To you. Yeah. Listening to you. Yeah, exactly.
That's the visual I got there. No poop involved.
No pooping involved. No.
Knights of Israel earlier, remember how he said he only had 40% of his premium, and he said he is just a few months into it. HELOC chose set up his policy, and he did a small PUA so far and is planning on doing another one.
Might just be more the mode of how you're putting the premium deposits in, the way they're being calculated. So that's more.
Yeah, it sounds monthly.
It's fine.
I think the small
right. If Joe did it, I'll tell you that.
Yeah, the small PUA is why you only have 40% because that in the first year is what's driving your cash value. You're not getting any cash value from that base part of it. So if you put in the base and you put in maybe 50% PUA and you have 40%, that kind of makes sense, right? So
yeah, and only being a few months in and us not noting the mode. So let's just assume that it was quarterly or it was monthly, then that's spot on because you just haven't fully funded a full year of PUAs.
Remember, looking at illustrations, Knight of Israel, your illustration always shows a year in the future. Like if you started, you're 50 now, and you look at your policy that's been approved or is in underwriting, it shows 51 because it's always showing you 12 months from now. It's always showing you a year in the future. So again, that mode of payment really matters on how you're capitalizing or putting money into your system.
Yeah, and to Dexter's point, he's kind of saying, what's the difference between the amount of cash value, the amount for cash value and PUA cash value? More goes to the PUA and the cash value increases as time goes by.
What the insurance company is showing you is a cash value number and a PUA cash value number is the base and the PUA rider. So in the early years, you're going to see zero cash value because the base generates basically no cash value, and you're going to see a large number in the PUA side. Over time, that base is going to generate a bunch of cash value. But to to find your total cash value, you got to add the two together, which your available loan amount is going to reflect that.
Love it. Thanks. That was a great explanation.
And that's kind of specific to One America, which I know is what he's looking at.
Yeah. All right. Gorva is saying, I'm a non-resident Canadian in taxation terms. Can I practice IBC with Canadian whole life policy while I am away? And what will be tax implications and how initial medical can be conducted?
Canada.
I mean, you definitely can practice IBC in Canada.
I'm a little confused. Is he a Canadian citizen or U.S. citizen?
Yeah. Well, I practice it IBC with. Oh yeah, good point.
I think it's someone that sounds like they're out of the country, they're Canadian, and they're looking to figure out how they're going to be set up and do the initial medical. And we could always connect you to somebody that's an infinite banking certified practitioner in Canada, because we actually can't help you with that problem.
Can someone ask Chris AI this? Because I honestly don't really know the answer. So like, let's just say somebody took a policy out in Canada, but then moved to the U.S. and still has that Canadian policy. Is it governed by U.S. tax law now or Canadian tax law? That is heavy.
All right. And he does have a couple more questions. So question 2 is, how can I connect with the team for further guidance? And then that obviously hinges on if you're Canadian or U.S.
He's Canadian.
If you're a Canadian citizen living in Canada, that's easy. I mean, you're governed by all the normal rules.
He said non-resident Canadian, so I think he's living here in the U.S. as a Canadian citizen. If that's
where are you filing taxes? Let's start with that. And I'm not a CPA, I can't give tax advice, but that's one.
He did say non-resident in taxation, non-resident Canadian in taxation terms.
I read that as he's living here in the U.S. as a Canadian citizen.
Yeah.
If that's the case, we can help you get a policy here.
Is that, what's his name? Is that him at the bottom there commenting?
Okay,
so Canadian citizen, Canadian in Middle East, Canada.
No.
So yeah, you're going to be governed by Canada. So essentially the tax-free nature we benefit from here in the US, you're not going to benefit from that because you're filing taxes in Canada. So, being a Canadian citizen, filing taxes in Canada, yeah, that's an easy one. So how that basically works, and I don't always get this exactly right because it's a bit wonky, but anything above cost basis. So, your premiums you put in, that would generate your cost basis. So anything above that is taxed like any investment would be. Not as good as the US, but it still does work really well. So you just got to factor that taxation in above and beyond cost basis. I'm not going to say it. We got it pretty good here in the US with that.
He was asking about the medical and how that would work. Yeah, we can connect you with our Canadian counterpart to explore that. Potentially, you might not be able to get a policy while you're living in the Middle East as a more risky area, but they can help you figure that out.
All right, love it. Okay, Jordy is asking, will the vault take place of what our implementation specialist is creating for us with the CFA and debt map?
Yes, in the future, but not right now.
Okay. B. Marsh is saying, I'm 72 years old. Should I get a policy on me or my 38-year-old son?
38-year-old son.
Probably the son.
But I don't. There could be a reason. Yeah, Jason's like, wait. There could be a reason why the coverage should be on you, and that would be a death benefit legacy play. But that would be, really up to you. But simple surface level sniff, 38-year-old.
Okay. Lauren is saying, I added a PUA rider on my wife's policy 10 years into it. I believe I was blessed to be able to do that.
For sure.
Mutual trust.
Yeah. Okay.
Adding a PUA rider to a policy, that wasn't designed for it initially, that there's a bit of.
I'm sure you had to go through underwriting with that, but that's unique.
You got to qualify for it health wise. That's good.
Yeah.
And then Gaurav is saying again, in the order of priority of taxation, countering inflation, and seamless inheritance. Chris, which of your designs will you prefer? So Slayer, 50/50, or 1090, or something special.
There's
and then
one thing that I
might
don't
use
know.
Canadian.
Is there a dump in? Are you doing a dump in deposit? Because that's going to heavily determine that.
This is the Canadian guy. So
Yeah, but their designs are relatively the same and how they
Okay.
build
Yeah.
them. Yeah, I mean, they're not too far off from what we do. So basically, it's really going to come down to whether you're doing a big dump in. In other words, like, keep numbers simple. You set up a policy that you want to dump in $100,000 right up front one time, and then you want to do $10,000 a year. In that case, probably you'd want to run something closer to the 50/50 design, because it's going to give you that ability to redline it and build it, as close to the rules. But again, I'm speaking in US terms. So again, double check this with the Canadian counterpart, because these are a bit different. But the most efficient design that we typically will run is somewhere around a 75/25. That's a pretty efficient standard run of the mill, kind of like you're gonna hit a home run with that almost every time. I would be very cautious on 90/10s because it's going to hurt you later, and because there's a heavy need of term insurance in them. I'm not saying they're bad. They got to be for a very specific need. And when you start mentioning seamless inheritance, I start thinking, okay, you want more death benefit. I start leaning definitely away from the 90/10 and probably more toward like a Slayer design would actually probably be a really good blend that gives you a good inheritance, because it gives you a little more death benefit. You're going to counter inflation because you're going to hit your efficiency point pretty quickly. And the Slayer is a 65/35. But again, there's two ways you got to look at all these designs. There's dumping and non-dumping. So they're not the same. You can't say, okay, Slayer, but I want to dump 100 grand. You got to play the numbers. And really the best way to do it is not to get caught up in like the splits. It's to get caught up in how do you redline the policy based on what you're putting into it. And that's usually the best way to look at it.
All right. And then Navigate Your Ventures is saying, I know you're not tax advisors, more curious how you would set up a car lease to your company. Unsure how to figure out depreciation value. I am beginning to dig into the case for IBC now.
Oh, it's such a great book. And it's funny, I did a YouTube video. You got to go back a while, but just go on my YouTube channel and type in get paid to drive a company car. I did a whole summary of how to do that. So bankrate.com is where I did my calculator for the lease when I did that G-Wagon lease. So bankrate.com has a lease calculator, and it will help you determine the depreciation. And then what I did is I just went online and I said, what is the depreciation on this vehicle? And then you just build that into the modeling. That's a good question. And that is a fantastic book. I'm really happy you're reading that. And I'm even more happy that you're honed in on that one car lease to your company, because I got so infatuated with that literally, like, I wrote the whole script for the YouTube video and then went and recorded the YouTube video and implemented that. I didn't keep that vehicle very long, but just COVID hit and had a really cool opportunity to make a lot of money on it.
All right, great. And then Knights of Israel is coming back saying, so if I put the full PUA in for the year, I'll see a higher percentage at the end of the year or within a month.
Roger that.
Once you put it in, you'll see the percentage go up.
Right off the bat. Yep.
There you
All right. And then Navigate Your Ventures is saying, has Tessa's book, Courage to Change, become a New York Times bestseller yet?
I've sold a couple hundred copies, but no New York bestseller. Thank you, though.
Not yet. Not yet.
That's super good for a book.
Well, thank you.
We've only done 203 copies of the companion, just to give you a reference.
Well, that does make me feel good. Sorry.
The companion book.
Compete with the good boys.
And Joe is saying, if I do an $8,000 dump in, am I required to do 10% each year after that? Or can I just do a single dumping in and my monthly premium deposit for the rest of my life of the policy?
I have to read that one again.
Yeah, I don't know where the 10% is coming in.
Well, your dump-in and your premium are two separate things. So your premium is the premium, the dump-in is the dump-in. So after the initial year,
using 10% for 10-time rule.
I don't know.
Required.
I really think the 10% is misstated. I think they're referring to the 10-time rule, like the 800, 8,000.
Uh-oh.
That's the answer to that one is
That's
it
even a
depends.
sliding scale.
Yeah, it depends on your age and the premium and all that.
Eliminate the 10% part, and the answer is yes.
Yeah, there you go.
Yeah, so yes to an $8,000 dump in, and then just the monthly premium for the rest of the life of the policy.
Yeah, we're
That's
just getting
the way
tricked.
it works.
And also keep in mind the life of the policy. What's that mean? It doesn't mean your life. I mean you can reduce the premiums, and most times they do go down. They have to sometimes. That's actually one thing a lot of times I hear from people. They're scared of the premiums for life because that's what they interpret, that you have to pay it for never stop. But in reality, it does stop, and typically they sometimes have to go down. So, and you
I know mine go down after I think 10 years. Like year 11, it's significantly smaller.
Yeah, it's your base. You're looking at your base.
You don't have to drop it down though either. In most cases, you don't have to.
That is something I'm newly learning because that policy I'm on year 6. So like I would want to keep paying more rather than less because I know what I know.
And I've been doing something interesting. I'll do an illustration that shows it, like what you're talking about, where we drop it down. But I'll send them another illustration that says, hey, by the way, this is the max funding as well. And so they can see both. And that has solved a lot of questions, by the way, just by doing that. It takes a bit more work for me to send 2 policy illustrations, but man, it clarifies a lot.
Okay, so he's saying from the $100,000 example a minute ago. So I don't know how the 8,000 dump in.
Maybe he's thinking of an 80,000 dump in as well as a 20,000 annual premium for the first year, and then do monthly in the future years.
Okay.
If he's thinking in that line, the answer to your question is still yes. I mean, the dump in can be just a one-time thing, and then monthly premium deposits going forward. Yeah. But I don't know if I'm reading the questions correctly.
Right.
That's okay. We'll make up answers anyhow, right, guys and gals?
Yeah, clarify in the chat.
Yeah.
50,000. That's managed.
Oh, yeah, but that's 10 times, not 10%. Yeah, I guess, yeah. So 10 times, 10%, I guess. Yeah, the 100,000. If general rule of thumb, if age plays a factor in this, underwriting, like your rating plays a factor in this. So again, this is not ironclad, but typically if you put 100 grand in, 10,000 would be your minimum. So if you put 8,000 in, 8,000 would be your minimum. So hold on. 110, 8,000 would it be 800? But 800 wouldn't be enough. But essentially that's kind of how you're doing it. Just book a call with us and have us run some scenarios.
Yeah, because if you do 100,000 and a 10,000 premium, you almost have no PUAs in the premium.
There is no exact science to policy design because it's case by case. We say that all the time. There's no one design that's exactly the same. Now, do we have models that we go off of and templates? Absolutely. But sometimes I wish I never created the templates and put them out in the public, because then people want that. And I'm like, well, that isn't the most efficient. But I said in the video based on these factors of that example. It's just a moving target based on probably 3 major factors: your age, the amounts, and then your underwriting decision.
Your income too is a factor too. How much can you be underwritten for?
Very true. Your human life value. Yeah. So there's lots of moving parts. The best thing to do is just tell us what your goal is. What is the problem you're trying to solve? And then we will put together the most effective and efficient design for that particular need. That's the best way to answer that question. Yeah. All right. That a wrap?
And that is a wrap.
All right, folks. Great questions. They came right up to the final. Actually, we're 6 minutes over, but thank you all for joining us for this episode of Ask Me Anything Happy Hour. And we'll see you tomorrow for the quick start. Oh my God, I had to think about that. The quick start webinar with Noah Harris, and that is at 1 p.m. Eastern. Thanks, everybody.
Thank you.